This is the fourth video in a series called The Financial Crisis Timeline, where I focus on the events of the credit crisis of 2008 and 2009. In my previous video, I talked about Hank Paulson and his TARP program. In this video, I want to talk about the new Treasury Secretary, Tim Geithner, and his solution to the crisis, which was called the TALF program. After Barack Obama was elected to the presidency, people around the world anxiously awaited his decision for a new Secretary of Treasury. That was certainly on the top of his priorities list. There were several candidates that were rumored to be under consideration, including Jamie Dimon, who was the CEO of J.P. Morgan Chase, Larry Summers, who was a former president of Harvard and a Secretary of Treasury under President Clinton, and probably most famously was Warren Buffett, the legendary investor. After a few weeks of deliberation, Obama announced on November 21st of 2008 that Tim Geithner was going to be the new Secretary of Treasury. Tim Geithner's background was actually in the formal Federal Reserve banking sector. He was the head of the Federal Reserve Bank of New York, and he had been in the public service and the banking public sector for quite a long time. He wasn't really a Wall Street alum per se. And for this reason and for several other reasons, the markets reacted pretty favorably to the news. A lot of investors had believed that the original TARP plan, Hank Paulson's plan, had not been very effective in getting lending going, and additional action was needed. So Geithner, as I mentioned, his background was in macroeconomic issues, and that is certainly the approach that he has taken in designing the TALF plan. So let's move on to what exactly was TALF? Well, let's first understand what it stands for. TALF stands for the Troubled Asset-Backed Securities Loan Facility, and that's a pretty big mouthful right there. It was originally announced on November 25th, 2008, which was really just a few days after he had been appointed to the position. So he already had some idea of what he was going to do, but it took a few months for him to flesh out all the details. The basic idea behind TALF was to remove the toxic assets from the bank's balance sheets through a series of public-private partnerships. And I'm going to talk about this a little bit later on in the video. The plan was announced, the details of the plan, that is, were announced on March of 2009. So it took him, as I said, several months to kind of put everything together. But the focus, what made the TALF plan fundamentally different, was that instead of TARP, the TALF plan would remove the toxic assets from the banks. They would focus on taking them off the balance sheets. While remember, in TARP, the idea was to invest directly in the companies. You were buying shares, stakes, equity stakes in the banks themselves. So let's try to understand how Tim Geithner wanted to achieve this outcome. So the first step would be to set discounted prices for the toxic securities. This would give the banks some incentive to sell them because they would not be getting full value, but they'd be getting something, probably more than they would get on the open market. But it would also give investors, private investors, some incentive to buy them because they could maybe pick them up at a little bit cheaper rate than they would otherwise. The next step would be the Treasury would find private investors, hedge funds, private equity firms, and they would basically broker a deal to purchase these toxic assets. So now the toxic assets would be transferred from the banks to the books of the hedge funds and private equity firms, and in return the banks would receive cash, and they could start lending this cash. That was the principal idea, the goal, to get the economy moving again. The Treasury also realized that they needed to sweeten the deal a little bit for the private investors because, remember, these assets were very risky. They're very hard to move. So they decided to sweeten the pot a little bit. And the way they did this was the Treasury would use $200 billion in taxpayer money to insure the toxic assets against loss. Now, this is very interesting. It actually brings up some of the moral hazard issues I talked about in my previous video. And I'll discuss that a little bit more later. But the goal here, ultimately, the broad vision, as I mentioned, was that the banks would be free of the assets and could resume lending once again. Now, how did the market respond to this? Well, in March of 2009, the stock market, at least the first several days, was taking a real beating. People were worried about financial Armageddon in the wake of AIG's massive losses. But Tim Geithner's plan really elicited a very positive response up front. People were very, very enthusiastic about this idea. They felt, okay, the banks will get some benefit. Private investors might be able to make some money as well, so they'll have a strong incentive to participate in this plan. But there were also a lot of economists and public officials who were fairly concerned. The plan seemed very unfair to the taxpayer. Think about it. If things go well, the private investors would make money, but if things go badly, the taxpayer would pick up the bill. Remember, that the part of the plan was $200 billion in government-funded insurance for these toxic assets. So if the assets go up in value, fine. But if they go down in value, the private investors are somewhat protected. So we're essentially subsidizing the private companies a little bit, the private equity firms or the hedge funds, and we're subsidizing their profits. So that was certainly an area of concern. Under the TALF program, the risk was basically transferred from the banks to the American taxpayer. We as American taxpayers are picking up the cost of this insurance on these toxic assets. But the banks are free to lend, and private corporations who purchase the assets may have some opportunity to profit as well. So a lot of economists were very skeptical of this plan, and they thought it had moral hazard ramifications as well, similar to Hank Paulson's plan. So I hope this video has helped you understand the TALF plan a little bit. I'm actually going to try to do a couple of videos on the details of TARP and TALF and compare and contrast them a little bit more specifically. But in my next video, I want to shift gears and talk about the AIG situation, American International Group, because I know that's something that a lot of people don't understand as well. So thank you very much for watching, and for similar videos in the Financial Crisis series, I recommend you visit my website, www.canjo.com.